Welcome back to the deep dive. You know, markets, they're always changing. One minute, everyone is talking about new highs, and then bam, things shift, like what we're seeing now.
Yeah, it's like a roller coaster sometimes. And when there's a dip, especially in the tech-heavy Nasdaq Q like we're seeing, it can be a little unnerving for investors. I mean, year to date, it's down about 3.8%.
That's not nothing.
Not at all.
Yeah.
And even more, it's off about 7.5% from its all-time high. So we're getting pretty darn close to what's considered a technical correction territory. Makes you wonder, doesn't it?
It does. It does. Is this a sign of trouble or is it an opportunity? I mean, a lot of our listeners are probably thinking, are there bargains to be found in this Nasdaq Q dip?
You hit the nail on the head. That's the big question, right? And that's exactly what we're going to try to figure out in this deep dive. We're going to look at some analysis from the folks over at Otley Fool. They've highlighted 3 companies that they think might be undervalued right now.
So 3 potential bargains in this choppy market. Interesting.
Yeah. And the companies are Advanced Micro Devices, AMD for short. Got it. Then we've got Broadcom.
Okay.
And, of course, the behemoth, Amazon.
So our mission, if you choose to accept it, is to dig into these arguments, see if they hold water, see if these companies really do represent compelling opportunities, even though the Nasdaq Q is having a bit of a rough time.
Precisely.
All right, let's kick things off with AMD. This is a company that has, let's just say, seen better days in the stock market.
Yeah, their stock price has taken a pretty significant hit. I'm talking about a 55% pullback from its peak over the past year.
Ooh, 55%. That's a lot. What's going on there? Why such a big drop?
Well, some of the initial reasons cited, paint a bit of a gloomy picture. Slowdown in their gaming and embedded segments. Even the company itself is forecasting a decline in revenue coming up. So, at first glance, not exactly a rosy situation.
I mean, that doesn't sound like a bargain. That sounds like trouble.
It does, right? But as with most things, there's always more to the story.
Okay, so let's dig a little deeper here. What are the arguments, then, for why this might be an overreaction?
So first, let's talk about their data center segment, a huge part of their business. It's important to note that their Q1 first quarter, often sees a quarter-over-quarter decline. It's kind of a seasonal thing for them. We saw it last year, too. So this dip might not be as alarming as it seems.
Oh, so it's not necessarily like a sudden drop in demand, just part of their normal business cycle.
Exactly. Now, another interesting point is AMD's position in the AI world. They're not really competing head-to-head with NVIDIA in that high-end AI accelerator market, right? But there's this new thing, DeepSeek. It basically makes running AI models cheaper.
Okay, so more affordable AI.
Right. And that could be a big boost for AMD's more budget-friendly AI offerings. Because if AI becomes more accessible, more businesses and developers will be able to use it. And that could lead to an overall increase in demand for AI hardware, benefiting AMD, even if they're not the top dog.
So a rising tide lifts all boats, so to speak. Even if they're not the absolute leader, a growing AI market is good for them.
Exactly. And if you look at AMD's overall revenue, their growth is actually pretty impressive. I mean, fourth quarter of 2024, they posted a 24% year-over-year increase in revenue, hit $7.7 billion. And just to put that in perspective, in the second quarter of 2024, their year-over-year growth was only 9%.
Wow. That's a big jump in just a couple of quarters.
Right. So maybe that whole narrative of AMD slowing down, well, it needs a little bit of nuance. Because when you look at the numbers, the picture is a bit more complicated. And another positive sign is that their embedded segment, remember that was a weak spot earlier, well, the revenue decline there is shrinking. Like in Q2, it was down 41% year over year. Ouch. But in Q4, that decline narrowed to just 13%. So things are looking up on that front.
Okay, so some positive trends there. But what about that gaming revenue decline, that 59%? That's still a pretty big chunk of their business, right?
No doubt, that's a big number. But you got to consider the context of the gaming console market. AMD's 2 biggest customers for gaming chips are Microsoft and Sony. And guess what? They haven't released new consoles in a while. And those new console releases, those are huge drivers for gaming chip sales. So this decline, it's likely more about the console cycle than anything else.
So no new PlayStations or Xboxes means less demand for AMD chips. Makes sense.
Yeah, it's not like they're losing ground to competitors in gaming technology. It's just the timing of the market.
Yeah.
Now let's talk about valuation. AMD's PE ratio, that's price to earnings, currently sits at 102.
Woof, 102, that seems really high.
Yeah, it does, right. But if we look at their forward PE ratio, it's only 22.
Okay, so big difference there. What's the deal with that?
Well, that forward PE of 22, that's more in line with what you'd expect from a mature company with decent growth prospects. So what this tells us is that the market, even with the current stock price, is betting on AMD's earnings to grow significantly in the future.
So they're expecting big things from AMD, even if the current picture is a little mixed.
Yeah. So the argument for AMD being a bargain is that they've got some things going for them, like improving trends in those key business segments, that accelerating revenue growth overall, and a stock price that's been beaten down, but with a forward valuation that looks pretty attractive.
All right, I'm starting to see the potential there. Okay, let's move on to company number 2, Broadcom. Another tech giant that's seen its stock price drop lately.
Yeah, they've had about a 27% sell-off. And, sometimes these big market dips, they can create some really good buying opportunities for patient investors.
That's the thinking, right? That this is a chance to get a good company at a discount.
Exactly. And the case for Broadcom is that their long-term potential, it's still very strong, especially in this hot area of AI, artificial intelligence.
Okay, so they're not just some overhyped company that got caught in the tech bubble bursting. There's real substance there.
Absolutely. Broadcom, they've got strong fundamentals, and especially their position in AI. That's a major plus. They're a big player in AI inference chips.
Remind me, what are inference chips?
Inference chips. Those are the chips that are used to actually run AI models. So once the model's trained, it's the inference chips that put it into action.
Got it. So if AI is going to be everywhere, Broadcom's in a good spot.
Exactly. And they're not just dabbling in AI. They're working with some of the biggest names in the business, the AI hyperscalers, the companies building the massive AI infrastructure. So they're right in the thick of it.
That's good company to keep.
For sure. And their projected revenue from AI, it's mind-blowing. They're saying it could hit somewhere between $60 and $90 billion by 2027.
Whoa, 60 to 90 billion.
Yeah. And to put that into perspective, their AI revenue in 2024 was about $12.2 billion.
Yeah.
So we're talking about a massive potential for growth here.
That's not just growth. That's like exponential growth.
Absolutely. But here's another thing about Broadcom that makes them interesting. They're not just an AI company. They're not even just a semiconductor company. They've got a diversified business.
So they're not putting all their eggs in one basket.
Nope. They have a strong foundation in communications technology, but they've also got a big software business. Like in 2024, 32% of their revenue came from software.
So that helps to smooth out the bumps in the road, right? Because the semiconductor industry, it can be pretty cyclical, up and down.
You got it. That software business, it provides some stability. And when you factor all this in, analysts are predicting that Broadcom's earnings will grow at an average annual rate of about 18% over the next 3 to 5 years.
18% per year. That's a really healthy clip.
It is. And then there's the valuation, their PEG ratio. That's a metric that compares their PE ratio to their expected earnings growth. It's down to about 1.7 now. And anything under 2, that's generally considered to be pretty reasonably priced, especially for a company with Broadcom's growth prospects.
So the takeaway here is that Broadcom, even after the stock dip, looks like a solid long-term investment.
Right. They're a leader in a high-growth market, they've got a diversified business, and the valuation seems reasonable. Hard to argue with that.
Makes sense. All right, last but not least, let's talk Amazon. Now, they haven't seen as big a drop as AMD or Broadcom, but it's still down, right?
Yeah, it's down just over 15% from its all-time high. It's not a huge crash, but for a company as gigantic as Amazon, a 15% drop is still a significant move.
And what's driving that decline?
Well, there are a few factors. The economy's been a little shaky lately. Some of the recent economic data hasn't been great. There are worries about tariffs going up. And then there's been this cooling off of enthusiasm for AI stocks in general.
So a mix of general economic concerns and maybe a little bit of spillover from that AI hype cycle.
Yeah. But the argument for buying Amazon now is that these are short-term blips, not some fundamental problem with Amazon's business.
Okay, so it's more about market noise than anything else.
Right. Because Amazon, they have a long history of delivering for their investors, even when there are negative headlines.
Yeah, they've weathered a lot of storms over the years.
And to prove that point, check this out. In the past 3 years alone, Amazon stock has had 5 separate drops of 15% or more from its all-time highs. And this recent dip, it's just one of them. But here's the kicker. Every single time before, the stock not only recovered, but went on to hit new all-time highs.
So those dips were buying opportunities in hindsight.
Exactly. And one of those dips was a doozy back in late 2022. The stock plunged more than 50% from its peak. But if you had bought Amazon stock at the beginning of 2023, even after this recent 15% pullback, you'd be sitting pretty. A $10,000 investment back then would be worth over $24,000 now.
That's a pretty strong return, especially considering the market's been a bit wobbly lately.
Right. It shows that sometimes when the market overreacts, it creates opportunities for those who are patient and have a long-term view.
Okay, so history seems to be on Amazon's side. Now, what about their core businesses? E-commerce, AWS, advertising, are those showing signs of weakness?
Not really. Amazon's got a reputation for strong management and a very diversified business. They're the dominant force in e-commerce. They've got the leading cloud computing platform with AWS, and their advertising business is growing like crazy.
So they're not just a one-trick pony?
Nope. That diversification helps them to ride out economic turbulence because they're not too reliant on any single part of the economy.
So even if one area slows down, they've got other engines to keep them going.
Precisely. And that's why the long-term outlook for Amazon remains positive. They're built to withstand these kinds of economic ups and downs.
All right, so the case for Amazon is that they've got a history of bouncing back strong from market dips, their core businesses are solid, and they're well diversified to handle whatever the economy throws at them.
You nailed it. It's about focusing on the long-term potential and not getting too caught up in the day-to-day market fluctuations.
Okay, so we've looked at 3 potential bargains in this shaky Nasdaq queue: AMD, Broadcom, and Amazon, each with its own story and its own set of arguments for why it might be undervalued right now.
And just to recap, with AMD, it's about those improving business trends, that accelerating revenue growth, and that attractive forward valuation.
With Broadcom, it's about their leadership in the growing AI market, their diversified business model, and their reasonable valuation.
And with Amazon, it's about their historical resilience, the strength of their core businesses, and their ability to navigate economic uncertainty.
But before we wrap up, it's crucial to remember that all investments come with risks. You always need to do your own research, your own due diligence before making any investment decisions.
Absolutely. These analyses are helpful starting points, but they're not guarantees.
So don't just take our word for it. Dig in and do your own homework. And as you're thinking about these companies in this market environment, here's a question for you to ponder.
I like it.
What other established tech companies besides these 3 might also be presenting bargain opportunities in this volatile market? And what are the signs you would look for to spot those potential bargains?
Excellent question. It really gets you thinking about the bigger picture.
Because the market, it's always creating new opportunities. It's just a matter of knowing what to look for.
That's the key. Thanks for joining us for this deep dive.
And happy hunting out there.